Moments ago, we spoke with the management of Greaves Cotton, but that was just one of the auto companies or auto-related companies that reported numbers. What is the street expecting from the entire auto pack this time around? This is our special quarter se quarter tak, where we bring you earnings expectations from each sector. And let's drive across to Sudarshan, who will tell us what one is expecting from the auto sector. Sudarshan.
So the BSE Auto Index underperformed the Sensex by 600 basis points in Q3 FY25, and this comes after a continued outperformance over last 3 years. And despite hopes for a stronger post-festive recovery, demand across key segments fell short of expectations, leaving the industry grappling with several challenges. Seasonal pressures, including heightened discounts and weaker product mix, compounded these issues. However, stabilizing commodity prices provided some relief. Talking first about two-wheelers, the two-wheeler segment is likely to deliver a subdued performance in Q3 with wholesale volumes remaining largely flat year-on-year. Adverse changes in product mix are expected to impact average selling prices negatively, with a sequential decline of up to 1%, that is the projection. And margins are also likely to contract by 50 basis points sequentially, reflecting the pressure on profitability. For four-wheelers, it's a tale of mixed trends. Performance is likely to vary across key players. Mahindra & Mahindra led the pack with 20% year-on-year growth in auto volumes, followed by Maruti Suzuki at 13%. But Tata Motors reported flat domestic dispatches, while Hyundai's volumes declined 5%. The broader market remains weak with elevated inventory levels and rising discounts, signaling underlying demand concerns. However, for commercial vehicles, a higher share of medium and heavy commercial vehicles is expected to drive average selling price improvement and margin gains. Amongst four-wheelers, tractor demand stood out as a clear positive, with hoses rebounding strongly, and that is up 18% year-on-year. This growth reflects robust rural demand and improved agricultural sentiment. Tractor makers like M&M and Escorts are expected to report improvement in margins sequentially. For ancillary companies, ancillary players' outperformance may continue. Revenue growth for ancillary companies is projected at 16% YOY in Q3 versus 11% anticipated for OEMs. Premiumization trends and higher content per vehicle are driving robust performance for players like Samvardhana Motherson and Uno Minda, and both are expected to deliver double-digit revenue growth. The tire segment, after facing multiple headwinds, is likely to bottom out in Q3. Stabilizing rubber prices and potential price hikes could boost margins, providing a tailwind for tire manufacturers. Talking about valuations, most stocks over the last few months have fallen in the range of 30 to 40%. But if you look at valuations, most stocks except Maruti are still trading near to or higher than the 5-year average. In two-wheelers, TVS Motor remains the most expensive stock, followed by Eicher and Bajaj Auto. In the four-wheelers, M&M has narrowed the gap with Maruti, and now both companies are trading at a similar valuation. And talking about the valuation for the tire sectors, it's like both Apollo Tyres and Balkrishna Industries are trading somewhere near to 5-year average. So overall, Q3 it's going to be a mixed quarter, but more than the earnings, the focus would be on the commentary, what these companies say about Q4 or going forward.
All right, Sudarshan, thank you for that. It's a very detailed expectation of what the auto sector is likely to do in the third quarter. And to take this forward, we are now being joined by Jay Kale, who is the Senior Vice President of Research at Elara Capital, who is joining in on the show. Jay, good afternoon. Thank you for joining in. You know, you're going through your note where you mentioned that you're expecting margins to drop for most of these auto companies this quarter, be it sequentially or on a year-on-year basis. Well, one of the factors you can attribute is to subdued demand, but is there any other factor that you are picking up when it comes to attributing it to this potential margin fall?
Yeah, good afternoon. Yeah, we do have most companies reporting QOQ margin contraction, and the expectation is that with festive season, you normally see the lower end also coming back a little better off. So apart from relatively subdued demand, it is also the mix that will play a role in terms of relatively weaker margins, especially on a QOQ basis, if we have to talk mainly about two-wheelers. In passenger vehicles, of course, mix has been largely stable, but it is different for different companies in terms of how their volumes are. But in passenger vehicles, I think the discounting has been at elevated levels, and hence there could be some bit of QOQ pressure on margins. which normally happens in a Q3 versus Q2. But this time, of course, we have seen reports of discounting being elevated for the passenger vehicle industry, especially.
All right. I had a two-part question for you, Jeff. One was, while most on the street are expecting, some sort of qualitative commentary from the management, what are your own initial assessments of the next couple of quarters? How do you expect demand to grow for the sector? And the second part is, what are your thoughts on this Maruti versus M&M debate? Because the valuation gap is now narrowing, with M&M having the additional benefit of, rural recovery, perhaps aiding the farm equipment business as well, notwithstanding the weakness that we're seeing in CVs, and the tailwind of their SUV PV business as well. Which one should one bet on?
I think both have their strengths and weaknesses. Of course, if we see, first, to your question to your industry growth assumptions, of course, in FY25, we are expecting two-wheeler industry to grow at around 10%. Passenger vehicle will grow at around 4 to 5%. But we have seen some green shoots in demand in December, mainly led by discounts for passenger vehicle industry. One needs to see how that sustains going forward. To the debate of Maruti versus Mahindra, of course, Mahindra has been growing in strong double digits on the back of new model launches, whereas Maruti will be piggybacking more on the hope of industry growth revival. So I think, if you see Maruti's volume growth in FY25 will be single digits, whereas Mahindra will post close to 18 to 20% volume growth. So I think it's all about, industry growth coming back for Maruti, whereas for Mahindra, I think the sustenance of the new model launches and also the expectation of a strong response for their BEVs, which have been launched recently, that will be keenly watched for Mahindra. We are positive on both the names, Mahindra and Maruti.
What about Tata Motors, Jay? What are you anticipating this time around? Because there are challenges all around, right? Be it in the CV business, be it for JLR with the issues in China as well. And the stock having almost corrected 35 to 40% from its peak. What do you anticipate for Tata Motors this time around? And do you believe that any adverse expectations of a quarter like a bad quarter is already in the price?
Yeah, absolutely. I think there have been concerns on, I would say, especially on the JLR piece. I think the margin delivery of JLR will be keenly watched this quarter. And also the guidance of JLR for FY25 and FY26. There have been pressures on volumes, especially in China, which is now well known and well understood, and the stock has also reacted partly because of that. But I think one of the key things to watch out in Tata Motors results will be the JLR margin, of course, free cash flow, as well as your guidance for FY25.
What kind of hopes are you pinning on the Creta EV launch, and what are your thoughts on Hyundai?
Yeah, I think, again, Hyundai has a similar kind of triggers like Maruti in terms of, it's mainly betting on the industry growth revival, which needs to be seen how sustainable the December growth is going forward. Creta EV, of course, the Creta brand is quite strong. So the Creta EV will piggyback on the strong brand value of Creta as a brand. But it's not a born EV as yet, and we need to see how Hyundai launches born EV products going forward. But definitely, Creta brand will aid in the domestic market for the EV as well.
What about tires, Jay? I wanted to shift focus a bit from the auto companies to the tire names. There were reports of price hikes that these companies have undertaken, but are these price hikes enough to offset the rise in rubber prices, or do you expect some margin pressure for these tire companies as well this time around?
Yeah, absolutely. I mean, of course, we have seen price hikes and pricing power, and the industry has been relatively stable, I would say. But we have seen one tire company already report, right? CEAT, and we've seen that there has been pressure on a quarter-on-quarter margins despite the price increases taken. And the guidance on the RM index going forward also is more of flattish in Q4 versus Q3. So in our view, tire margins will continue to remain under pressure. Maybe kind of bottoming out in Q3, but Q4, Q1 will still not see a major increase as what was maybe earlier expected. With CET also coming and saying that we are seeing a flattish kind of RM index in Q4 as well, we believe the tire names will remain under pressure.
All right, thank you so much, Jay, for joining in and giving us what a preview into this sector would look like. We request you to join us once the results are announced as well, to give us your immediate analysis on those results and whether they actually meet or beat the expectations that we've set for this time around as well. But with that, we'll step into a short break, and as we do that, let's tell you a little more about the CNBC-TV18 app. Good news for our viewers: the India Business News leader is just a click away. This is the interface of the all-new CNBC-TV18 app, via which you can get instant access to breaking news, in-depth articles and financial world updates, all of them coming at your fingertips. Now, we've asked you to download this app from either the Apple Store or Google Play Store. If you can't find it still, just put your phone cameras up here, scan this QR code, and you will get the link from which you can download the CNBC-TV18 app. And once you do that, again, all the business world updates right at your fingertips.